Management commentary, or generally known management's discussion and analysis, is a narrative report that provides the context within which the analyst or any user of financial statement analyzes and interprets the financial position, financial performance, and cash flows of the reporting entity. Companies include a section of management commentary in which management discusses a variety of issues concerning the company, including the nature of its business, its past results, and its future outlook. It enables the analyst or user of financial statement to better understand the financial position, financial performance, and cash flows of the entity, and then interpret them according to their respective uses or decision making. Management's discussion and analysis enables the analyst to better understand the reported numbers in financial statements and the past performance of the company, as well as form expectations on the basis of the context provided in these analyses for the future. It also provides an opportunity to the management to communicate and explain its objectives and the respective strategies to achieve those objectives to the users of financial statements. The International Organization of Securities Commissions recommend to include management report in the annual report. Regulatory authorities such as the US SEC and the UK Financial Services Authority also requires the inclusion of management report in the annual report. The management report, or MD&A, may be audited or not audited depending on the regulatory requirements. For example, in Germany, a management report is required to be included in the financial reporting since 1931 and is required to be audited. The analyst therefore must consider whether the information in the MD&A is audited or non-audited while analyzing financial statements of a company. In 2010, the International Accounting Standard Board issued the IFRS Practice Statement Management Commentary with the objective to improve the quality of the discussion in the management report. It provides a broad, non-binding framework for the presentation of management commentary that relates to financial statement prepared in accordance with the International Financial Reporting Standards. The practice statement by itself is non-binding and not an IFRS. Therefore, it is a recommended statement that companies are encouraged and recommended to follow. However, if a specific country or jurisdiction requires companies to follow the practice statement, then companies must do so. The practice statement requires that the management commentary should include information that is essential to the understanding of the nature of the business of the entity, the management's objectives, and its strategies to meet those objectives, the entity's most significant resources, risks, and relationships, the operating results for this reporting year and past years, as well as future prospects, and the critical performance measures and indicators that management uses to evaluate the entity's performance against stated objectives. Management report is considered a good starting point to develop an understanding of the information provided in the financial statements of the company. Forward-looking disclosures in the management report related to planned capital expenditures, new stores opening, new products, divestitures, etc. are quite useful in forming expectations regarding future performance of the company. This is an excerpt from the management's discussion and analysis in the annual report of 2011 of Hershey Company. There is an increase of 7.2% in sales in 2011. The discussions provided here explain that the 7.2% increase in sales is due to 3.5% increase in the product prices, 3.4% increase in volume, and 0.3% due to favorable foreign currency exchange rate movements. This helps the users of financial statement, including the financial analyst, to better understand the increase in sales from 2010 to 2011. This excerpt from Hershey Company's 2011 annual report illustrates information on company's prospects. The analyst can use this information as an input in his or her own forecast of company's future financial statements and performance. Such forward-looking disclosures by management in the management report lead to more informed forecast by analysts regarding sales growth, dividends, earnings, and cash flows of the company. Financial statements in annual reports of the companies must be audited by an independent accounting firm in line with the international auditing standards. An audit report is a written opinion of the independent auditors on the financial statements of the company. The objective of the independent auditor in conducting an audit is to establish a reasonable assurance about the financial statements as a whole, that they are free from material misstatement, whether due to fraud or error, so that the auditor can opine whether the financial statements have been prepared in accordance with applicable financial reporting standards such as the International Financial Reporting Standards or the US GAAPs, that is Generally Accepted Accounting Principles, and also to report on the financial statements and communicate as required by the International Standards on Auditing in accordance with the auditor's findings. In publicly traded companies, the Independent Audit Committee oversees the audit process. The audit process provides a basis for the independent auditor to express an audit opinion on whether the information presented in the audited financial statements present fairly the financial position, performance, and cash flows of the company in accordance with a specified set of accounting standards. There are four types of audit opinion: an unqualified audit opinion, a qualified audit opinion, an adverse audit opinion, and a disclaimer of opinion. An unqualified audit opinion is the most desirable audit opinion for a company. It gives the company a clean chit that its financial statements are true and fair representation of its operations. It should be noted, however, that the wording of the audit opinion vary over different jurisdictions. The unqualified audit opinion is the one that the analyst will be looking to see in financial report that he or she expects to analyze. A qualified audit opinion is issued when there is some scope limitation or exception to accounting standards, when the auditor are unable to obtain sufficient evidence with respect to certain elements in the financial statements. This results in a scope limitation. Similarly, if there is an exception to an accounting standards or different accounting standards, in such cases the auditor will issue a qualified audit opinion. Exceptions in such cases and scope limitations are described in the audit report with additional explanatory paragraphs so that analysts or other users of financial statements can determine the importance of the exception. Scope limitations may arise due to restrictions imposed by the client. The restrictions imposed by the clients may hamper the ability of the auditor to obtain evidence for audit. Certain scope limitations such as fire or flood are beyond the control of the client, that is the company. In such cases too, the auditor is unable to obtain audit evidence. However, this is not the fault of the client, that is the company. Exceptions to accounting standards may arise due to circumstances that are specific to a company, industry, or economy, or even global, such as the global financial crisis of 2007-2009 and the current COVID-19 crisis. In such circumstances, companies may resort to not comply and prepare financial statements with the applicable financial reporting standard in the given jurisdictions. An adverse audit opinion is issued when the auditor determines that the financial statements are materially departing from the applicable accounting standards and do not truly and fairly present the financial position, performance, and cash flows of the firm. Generally, an analyst would never want to analyze these financial statements as they are under adverse audit opinion. Auditors issue a disclaimer of opinion when they are unable to issue an opinion on the financial statements due to some reasons such as scope limitations. Auditors, when encounter significant scope limitation, may resort to disclaimer of opinion. In such cases, they are unable to obtain sufficient evidence. Internal control system of a company is an internal system that is designed with the objective to ensuring that the company's process for generating financial reports is sound. In some jurisdictions, such as the United States, now it is a legal requirement that the auditor express an opinion on the soundness of the internal control system. Situations that may indicate that the company's internal control system is not sound include such as restatements to correct errors in previously issued financial statements, rapid growth, or numerous acquisitions in a short time. The management of publicly traded companies in the United States is now required to explicitly accept responsibility for the internal control system given its significance. In addition to annual financial statements, there are other sources of information available to the financial analyst. These include annual report or proxy statements. These are distributed to the shareholders regarding matters that are to be put to a vote in the company's annual or special general meeting of shareholders. These proxy statements include information on the management and directors' compensation, company stock performance, and any potential conflict of interest between management, shareholders, and the board of directors. Interim reports are generally unaudited and they may be semi-annual or quarterly financial statement with updated information that the company reports to different regulatory bodies or the stock exchange regarding its financial performance and position. In addition, companies also provide additional information which is available on their website, in press releases, and in conference call with analysts and investors. A very important press release is with respect to earning announcement. Analysts are quite interested in these earning announcements as these are made before the formal financial statements are filed by the company. Such earning announcements are generally followed by a conference call by the senior executives of the company in which they describe the financial performance of the company and also answer the questions that analysts pose them during the conference call. Companies also make the recordings of these conference calls available on their websites along with supplementary materials and the slides from the conference call presentation. Analysts must also gather data and information from external sources related to economy, industry, the company, and its peers or comparable companies. This will develop a better understanding of the past and expected performance of the company within the context of the economy, industry, and competition. Companies that are highly regulated will require the financial analyst to gather information on the current regulatory requirements as well as the expected future regulatory regime. If an analyst is studying a consumer-oriented company, he or she will require to seek direct experience of the products or service of the company, such as tasting the food, using the shampoo or soap, or visiting the stores or hotels. An analyst who is studying Apple will need to experience its products such as the computers, watches, and phones that Apple make. There are 6 steps or phases in financial statement analysis. The first phase is to determine the purpose and context of the financial statement analysis. The second step is to collect the data from internal and external sources. The third step is to process the data, that is to perform different calculations and calculate any ratios required. Fourth one is to analyze the processed data, and fifth is to develop and communicate the conclusions and recommendations to the intended audience. The sixth one is to follow up, that is to repeat the process periodically, that is from step 1 to step 5 again. The step 1, that is to articulate the purpose and the context of the analysis, is the most important one, as there are a number of tools and techniques available to do the same thing, and there is a large number of data at the disposal of the analyst. It is important to clearly articulate the purpose and the context of the analysis. The analyst function or role, such as if he or she is required to evaluate an equity or a debt investment or issuing a credit rating, will help in determining the purpose or objective of the financial analysis. So, for example, if the analyst is required to evaluate an equity, the objective is to analyze the stock to consider it for inclusion in an equity portfolio. The analyst needs to come up with specific questions that his analysis must answer. For this, the analyst will consider the communication with the client or his supervisor to identify the needs and concerns of the client or the supervisor. For example, if the client is interested in growth investing, then what features or attributes the stock must have to be considered for inclusion in the client's growth portfolio. In addition, there may be institutional guidelines related to specific work that may help the analyst in determining the nature and content of the reports provided, as well as the timetable and the resources available for the completion of the work. In the second phase, data is collected from a variety of internal and external sources, and that data is then organized into tables or statements or even completed questionnaires if applicable. In the third phase, the data from step 2 is processed to obtain adjusted financial statements, common size statements, ratios and graphs, and forecasts. The financial statements need to be adjusted for comparison across time and across companies. The common size statements are quite useful for comparison over time and across companies also, and similarly ratios and graphs are used to show the trend in performance over time. In the fourth step, both input as well as process data are analyzed and interpreted to provide answers to the questions that were posed in the step 1 of the analysis. In step 5, the analytical results are used to develop conclusions and recommendations that are communicated to the intended audience. Step 6 is a follow-up or a repetition of the earlier 5 steps periodically and is used to update the report or recommendation. For example, the analyst made a buy recommendation for Apple at the end of June. The analyst may or may not change his recommendation for the month of July if he follows up his earlier recommendation of June.